Good evening, everyone. You're all very welcome to today's weekly webinar for this week. We've had incredible volatility over the last 24, 48 hours. We've had incredible volatility tonight off the data prints earlier today. But of course, with Trump speaking even this evening as well. Systematically, we know September tends to be quite a volatile month. End of the summer markets back into normality. On record, if you were to look at the last 50 years, we know September tends to be a down month, and that's obviously something we focused on as well over the last few weeks, that we're expecting a little bit of a pullback, we're expecting a little bit of a correction in these markets, and we are absolutely getting it at the minute. So regardless whether you're focusing on the FX markets with the pickup in the dollar since Friday, beginning of the month, or whether you're actually looking at some of those other asset classes like your equity markets, your indices, or of course the crypto markets as well, where we've seen Ethereum in the back foot, we've seen directional into the end of August, and of course the altcoins as well, which has seen some heavy bleeding. So I suppose really the first place to really kind of focus on today, we're going to look at the calendar first. And then of course we can get into kind of on the session, and then of course more broadly beyond that. So when we look at today, there's a few things important today. We'll obviously look at today and then we'll kind of branch out into the rest of the week. We've obviously had the weaker prints, the ISM manufacturing prints at 3 o'clock come in a little bit weaker than expected. So the new orders was up at 51.4, and the employment index was also marginally higher as well, but the manufacturing PMI for August was slightly lower. So we're kind of looking around the 49 print. We got 48.7. The prices paid narrative has come down. So that's kind of relevant to what we talk about with the inflation narrative, because of course when the index and the price side is coming down, obviously that ties into some of those inflation metrics, PPI metrics, CPI metrics, and of course price expenditure indexes as well. So on that side, not massively worried on the manufacturing prices paid, but overall the manufacturing PMI is obviously weaker. Now, when we look at the broader global economy over the last probably 15 to 20 years, we've become a lot less manufacturing based and a lot more servicing based. You look at a lot of economies, they rely prevalently more so now on service output rather than necessarily manufacturing of goods and services. So yes, manufacturing of goods and services will always be important, but it certainly seems over the last kind of 10 years or so, there's been a little bit more of a shift towards the services as a predominantly stronger figure when it comes to data reporting. Now, today, of course, as well, we had harmonized consumer price indexes again from Europe coming in at 2.1% and 2.3%. So the price CPI data out of the Eurozone is slightly higher, but again at 2.3 and 2.1% year on year isn't massively concerning, because that's really kind of where the European Union and the ECB more broadly would want those levels. We talk about the longer term 2% target being the ideal scenario. So a little bit of volatility today, and of course as you look at the markets today, yes, the dollar is unchanged from what we've talked about over the last 2 weeks or so, the last 2 or 3 Tuesday sessions in our webinars. We've talked about how this dollar is very receptive, it's very back and forth, it's very range bound more broadly speaking, but it's not without its sharp movements. So on the 22nd, when Powell spoke, markets sold off with a little bit of a rally last week, beginning of last week into the tail end of last week, into kind of more the month end cycle. And of course what happened into month end, we actually saw that dollar roll over again from highs at around 98.50, 98.80 and underneath. And then of course at the beginning of this month, looking at Friday's lows and looking at Monday into today, we've actually seen a resurgence again in the dollar. But when you actually tie it back, when you actually look at the markets more broadly over the last couple of weeks in particular, right, you look at the last 2 DXY prints, not this week but the week before and the week before that, very little, very up and down, but marginally unchanged. Now there is a little bit of an inflection point there in the dollar on the weekly side of things, but we'll talk about that a little bit later on tonight. So this is a really concentrated zone. Every time we come down to that 97.50 print, we seem to rally off it, and simultaneously when we get up into those high 98s, 98.7, 98.8 and above, we get a little bit of an inflection point back down. So that is atypical of August consolidation, a little bit of volatility into summer, into end of summer, beginning of September, which we know traditionally as we've discussed in our group, how the nuances is that generally speaking, September on average has never been a positive month. We always see on average, I think somewhere between 0.5% to 1% down over the last 60 years on average when you look at September's performance relative to some of the other months. All right, so we obviously have to look at that. Then the second thing we also have to look at is this VIX, right? So we talked about the VIX last week. It was starting to gain a little bit more upside middle of last week. Now obviously we tailored back down Thursday, but into month end we saw that pick up on Friday, we saw that pick up on Monday. There was a little bit of a gap fill as well. You'll see that there for yourself, this big wick down on the CBOE volatility index for the S&P 500. And since then, really from Monday into today, we've seen that VIX index progress higher. Now when you look at it on a session to session basis, it's up about 25% on the day from the current level, but actually when you look at it in the grander scheme of things, it's not really massively weighted yet. But of course we've seen a little bit of a pickup over the last couple of days or so. So you're really looking for this VIX. If you're going to see a lot more risk off movement throughout the course of the month, you're really expecting another movement higher in the VIX, not just above this gap fill at 20 or 21, but you're going to be looking at the 25s, the 30s, and more than likely a spike that would mirror something like what we saw in December, right? This impulsive move in December where the VIX went from 14 to 28, it pretty much doubled. Again in February we went from 14.5, 14.8 all the way up to 29, so again pretty much doubled. Do I think we're going to get this type of volatility swing where we go to 55, 60? No, I don't, but I do think that the potential is for the VIX curve to actually break out beyond that kind of short-term top at, let's say, 20, and maybe get a little bit of a garnered move higher like what we saw, as I said, in December and January into February, and then onto into the end of March. All right, so that's what we'll kind of be looking at through the course of September. I definitely think that if you're gearing yourself towards buying equity or buying risk of any asset class, so whether it's S&Ps, whether it's the NASDAQ, whether it's crypto, I think there's a little bit of a patience game needed here. I think we have to be cognizant of the fact that these on a complete rampage for pretty much close to 5 months, from those March lows, April lows, but more prevalently really from the end of April, we went on this massive tear. So it really wouldn't be surprising if we saw actually a little bit more of a correction, maybe back into that 6,000, 6,200s, and then ultimately try and progress higher into Q4. Now again, a correction in September would be absolutely ideal because, as I said, even from the June breakout of the prior February highs where we had that massive 20-25% sell-off in April, we've yet to see any sort of pullback against that breakout that we saw in June. So when we broke higher in June, it was literally like just a complete runaway train. We went into a consolidation, we broke up, we came back down, we went for new highs, we came back down, we went for new highs last week into month end, and of course we're on the back foot today on the 9th of September. Sorry, the 2nd of September. I don't know why it's saying the 9th, it's reversing. 2nd of September. So naturally I think there's going to be a little bit more downside pressure. So we're looking at the DXY as a catalyst to potentially break up. We're also looking at the VIX for a potential catalyst to continue this a little bit more of an upward surge. But we're also looking at sentiment. We're also looking at the news, right? The sentiment today was quite bleak. A lot of positions, even when Trump was speaking at 7 o'clock tonight, there was a fairly strong emphasis on short geared positions. Now we were obviously mentioned that in our Telegram group as well, that there was a little bit more of an emphasis on those obviously leaning more to the downside, and that was looking at obviously the volatility in the centralized markets, not just the CFDs. So the centralized markets is really your futures. You can really see kind of what the actual order book, what is actually being displayed within the ladders, within the execution of these asset classes. And of course I mentioned that earlier on. So roughly at around about 3-4 o'clock today, there was around about 600. The 635 on the SPI was a very, very interesting level, and of course that was factoring in the significant negative exposure under spot that we were seeing today. So basically meant, in simple terms, the markets were leaning more towards the downside through the course of the session, and of course we saw that come through pretty clearly through the last as I said 4 or 5 hours. So now we've seen a little bit of a bottom, we've seen a little bit of a V bottom this evening. But again, very, very heavy selling into the open through the course of this morning. And into obviously US Open as well, but we found a little bit of a bottom around 1/2 4 or so. All right, so this is going to be very interesting. Now we are currently, as we look at the S&P market, as we look at the NASDAQ market, yes, both went very, very negative, but we're really only back to the lows of last Friday week. So you're talking not Friday gone by, the prior Friday, the 22nd, where we had that upward spike in the Powell movement. So this was obviously the Powell commentary from the 22nd. Basically what we've seen is the markets in its initial sell-off has really come back down to revisit those lows. So naturally enough, that is going to be a fairly pivotal area for the week around that 63.50. I think if we can encompass this, a breakthrough of this area, whether it's the S&Ps, whether it's the NAS, I think you're actually going to see a fairly aggressive breakdown, because beyond this area here is really the correctional movement that we're obviously talking about, which becomes a lot more personified, and below that then you're really looking at a very, very clear straight line break down to that 6200s, and that's of course where we had that dip and buy at the beginning of August. So we just obviously have to be very, very careful of that. Now the second thing we obviously have to look at is, well, when you look at these markets, it is forming a short-term bottom. So naturally, when you get an aggressive move like what we saw today, fairly straight selling into the open, beyond it into lows mid-late afternoon in the US, naturally there can be consequences where there is a little bit of a bounce back, what we call a dead cat bounce, or a little bit of a swing back up into the value area. Now the value area today, where yesterday it broke down from, was around at 64.50, we're down trading about 50-60 points lower today. At its lows we're down around 63.60, which is about 80 to 90 points. So we've bounced a little bit off the lows, but on the session, on the revised value area on the session, we're just trading marginally at or above it. So that'll be an interesting narrative for me into tomorrow, is do we see a dead cat bounce all the way back up into here, where you can see kind of visually around that 64.50, or whether it's a faded rally, basically creating kind of a mid-market high into the close. What we mean by mid-market high is basically a short-term correction, but not the whole way back, and then incrementally just rolling over again tomorrow and replicating, at which point then retest of lows becomes very clearly into track, with the potential then to try and break down. So basically, in a nutshell, what we're looking at tomorrow, next few days in particular, as we move back towards the date in the calendar, is really looking to see, do we see a pickup again in the VIX? Now the VIX is obviously rallied today, it's getting a little bit of a correction back down, but it's getting a correction back down because there's a little bit of a short-term bottom coming in the S&P. So naturally the two are negatively correlated. Now the second thing you want to look at here is you've got a really, the highs from the 21st, 22nd has been taken out around 18, so there's a potential pullback area there, but also in the VIX there's also a potential pullback area which would be around that 16. So for me, that area here between kind of 16 and 17 is going to be very interesting to see if there is a pullback, which would allow short-term bump up higher on the likes of the S&Ps, on the likes of the NAS, incrementally, to allow that to then move progressively higher. And again, this gap from the 4th of August has yet to be filled on the VIX. Now you have to remember, in volatility terms, this was the VIX at 21.64. This was the VIX today at 19. So you're still talking 2.5 points on the index, while today on the S&Ps, from the lows of the 21st and 22nd, they were pretty much revisited. So you can see how the S&P index is pretty much retesting those lows, whereas the VIX, if it was to come up into, let's say, 21, 22 range, you're probably incrementally looking for that to really break down sub 63.50 and ploughing more emphasis into the short bias. Okay, so that's allowing us to look at multiple things. We're looking at, obviously, the dollar situation. We're looking at the volatility side of things. We're looking at the narratives that we're seeing off of the news at the minute. We're looking also at the September seasonality factor, which we know tends to be quite bearish. So that's obviously helping us position the right side of the market. And of course, we're looking at the actual asset itself, the tradable asset, which is the S&P or the NAS. Now, the NASDAQ is also very, very similar in terms of its approach. Had a little bit of a run up last Thursday, back down into month end, really started to falter, and then of course yesterday into today we've really broke through that 23.4s down into that 23 handle. Again, like with the S&Ps, all it's really doing is revisiting those lows around that 23 handle. That 23 handle, nice psychological level. As I said, tomorrow if we were to get a little bit of a pullback on the VIX to this yellow area, it would allow for a short-term dead cat bounce in the likes of the NAS, in the likes of the S&Ps. That becomes a potential narrative. Let's say 23.3s, 23.4s could become a secondary reloading selling opportunity if it's a case that that VIX picks up again. Now, what are we looking for in terms of the VIX to pick up? Well, that's probably going to go back to the narratives that we're seeing in this media. Now, every move in the markets, there's always going to be a narrative. There's always going to be a news, or there's going to be a data print to try and support the move. But logically, when you look at the seasonality factors, when you look at your ladders, when you look at the volume, a lot of that can be preordinated in what's actually been seen through the volume profiles as well. And I think that's obviously quite an important note as well. Now, obviously today, a bit of a mixed data front. Trump was speaking. Trump has probably stabilized the markets a little bit this evening, but again, I don't think he's stabilized the markets himself directly. I think it's those heavy selling orders taking profits, markets trying to square off the book for the end of the day, and naturally then as all those sellers are evaporating out of the order book, we're seeing a little bit of a bounce back on the upside. So that's kind of what my train of thought is as we come to look at it. Now, as we move into the next couple of days, just to tidy things up, let me just fix the calendar. I've got all sorts of news. I'm just going to filter out the low volatility news. For tomorrow, we do have some GDP prints out in Asia tonight with Australia, PMIs as well. And we've Governor Bullock also speaking in the morning, with the President Lagarde of the ECB at 8:30 and the BOE man also speaking as well. And the Breeden from the BOE is also speaking also. Other than that, tomorrow we've got European prints with the PPI data prints. We've got German composite PPI and service PPIs. Again, that's back above 50 for the first time in a while. Interesting to see what's the narrative there associated with German data. Some of the German data prints last month weren't, at the beginning of the month weren't great, but towards the middle of the month actually started to rebound a little bit. So it'll be interesting to see if that team actually comes back in again. And as we move towards the better half of the session tomorrow, we move to the JOLTS numbers, right? So the JOLTS is job openings. On a Tuesday or Wednesday we get the JOLTS. Then on the Thursday we get the initial jobless claims and the ADP employment change. And then of course on Friday we get the big daddy itself, non-farm payrolls. Now the non-farm payrolls for me is very speculative because of course the figure by and large is generally leaked in advance. We also have the fact that the non-farm payrolls gets heavily revised over the last probably 6 months or so in particular. It gets heavily revised as well. Okay, so the big ones that I'll be looking at this week, I'm interested to look at the ADP employment change because of course that's the kind of the linear nuances regarding the private sector. Okay, so rather than just corporate, because of course non-farm payrolls does leave out the farming side, it does include public sector, which through the Biden administration was heavily propped up. There was a lot of wastage DEI positions being filled in the Biden administration, which meant that in a lot of ways the non-farm payrolls were generally kind of overestimated rather than being a true nature of the fact. So yes, this week's employment data in the US is going to be very interesting. JOLTS openings is also quite interesting. The JOLTS numbers over the last probably 6 to 12 months has come down. It was around the 9.5 million. It has kind of faded off in the last probably 6 months or so. We've seen really the JOLTS numbers come back. Now I don't know why that's not loading. Bear with me, guys. Let me just see if I can load it up again. Okay, it's becoming a little bit stagnant. I don't know what's happening here. So you can kind of see for yourself, this curve should generally populate, but for some reason it's not. It's not. I don't know why it's doing this. But basically you can see from yourself, even from the early parts of last year, around 8 to 9 million, we have come back down to those 7. So it'll be interesting to see if we start to break through that 7 million print. Basically what's happening here, when the JOLTS openings decreases, it's less available jobs is available on the market. So we talk about employment payrolls is one side of things, but also the JOLTS job openings is another as well. All right, so that's quite an interesting one tomorrow at 3 p.m, which a lot of people will be watching very closely. And then we move into Thursday. We have got the PMIs again, the S&P Global Composite PMI Index. We've got all of the ISM service side again, which will be interesting from the US perspective on Thursday. Now again, the deployment index, the new orders index, don't really focus too much on them. For me, the big one is the services PMI itself. Now, the previous figure was 50.1. This one's expected to be 51. Anything under, let's say, 50.7, 50.8 is going to be cause for disappointment, which effectively means those markets come under a little bit more pressure. So let's see what happens with the PMIs on Thursday. Again, narrative this week is very much pointed towards the downside. We know obviously the seasonality factor plays into that as well. And then of course to round out the week, we've got obviously non-farm payrolls on Friday. It's going to be the big one. Canadian labour data is out as well. And in the morning time in the UK, we've got UK retail sales and of course European GDP year on year on Q figures. So that again will be interesting. Now again, we've talked about the growth dynamic in Europe and the UK over the last 6 months. We know that those growth figures are really struggling. The pound figures a bit mixed recently, but overall quite underwhelming. And the same can also be said for the UK or the European Union, Eurozone, with the average growth expected to be around 1.4%. And of course, 1.4% is still shy of that 2.1%, 2.2, 2.3% CPI print. So naturally, if your inflation is at 2.3 and your growth is at 1.4, that over the long term leads to stagflation, right? Where basically the inflation is higher than the growth over the longer term, and absolutely nobody wants that. So the best way to do that is cut your rates, make the economy more accommodating, to see if you can drive upward pressures to basically bring forth that GDP. But obviously if you do that unnecessarily, of course that adds more issues with the underlying inflation print, because of course then it's artificial propping of up, which we saw during COVID, which actually was counterintuitive as it led to widespread inflation. So that's obviously something we need to be careful of. Now, as we move out of the calendar, back into these markets, we've obviously talked at length about the DXY. DXY still remains the same for me, stuck between 97.5 and the upper 98s until we see a more meaningful shift. I think these markets can continue to remain quite consolidated. Like, you even look at today, for example, very, very aggressive. It got to 98.6. It's creating a short-term top into the close, and looks quite reactive that it might actually pull back to the 98s. And of course, if that VIX moves lower, which it's currently doing into the close, and these risk-denominated assets get a little bit more of a headroom back up to the upside, then naturally the DXY is going to be a little bit more flat into the close. So you just have to be conscious of that. Now, in terms of the gold prices, the big one here over the last week has been this really strong breakout. It was noticed on Friday. It closed stronger on Friday. It was basically the highest all-time ever close on gold. And then of course we got a little bit of a retest Friday evening, continued to pick up into the weekend. Gold was taken home into basically the weekend trading, and then of course from there we continued progressing higher initially. So this was Monday. If I just zoom into this breakout, you've got this period of consolidation. We garner support again during the Asia session today, with a correction back to the value area this morning, which again was around this 34.75, and from there we've rejected, bounced, and continued progressing onwards. So there was a very clear break and retest initially. There was also the apex where we broke up. We came back to the value area from Monday, held that. We broke above the value area today, retested it and held it, and then of course kicked on again. So even from there we've gone from 34.90 to 35, nearly 35.40, and this gold price is continued to aggressively break out. So we've had a fairly considerable period of consolidation, very tight between 32.50s, 32.70 lows, 32.40, 32.50 highs, until Friday, where we've had that breakout. So there was a few opportunities to snipe the breakout there, based on the analysis we've done. If you took any of those opportunities, very, very, very well done. Again, I don't trade gold myself. It's not in my playbook of assets, but some of those moves there were quite clean. So if you benefited from that, well done. Euro dollar, as the DXY continues to remain quite consolidated, it's becoming still continues to be quite reactionary, under 17.50, 116 bases. And until we get a clear move on the DXY either way, you'd expect this consolidation structure within this kind of prior channel that we talked about previously to continue playing out. So at that moment in time, there's not really much else to say in euro dollar until we see a definitive move on the DXY, because as I said, every time we come up, now you're looking at this, you're seeing left shoulder, you're seeing a head, you're seeing a fairly gargantuan crisscross truck and trailer formation where we just go up and come directly back down and then obviously close under value area and move lower. So there is the potential there for a head and shoulders. Now, does that mean there's an inverse head and shoulders on DXY? Well, actually, funnily enough, when you look at the DXY, it's more geared towards a lower high formation, which for me is a little bit interesting because, of course, you've got 1, you've got 2, you've got the DXY breaking down. So you can maybe call it more of a triple bottom, perhaps, because, of course, you've got 1, you've got your 2nd, and you've got your 3rd with no clear breakout of this low. Okay, so it'll really be interesting to see whether this area here basically gives way. And if we do give way, you're looking for risk volatility to pick up, and you're really looking for that dollar breakout above 99. So that's really going to be the fulcrum point for me when it comes to euro dollar cable over the next few days and into the course of September. Now, the other thing we need to look at is obviously the cable print. Cable was kind of playing out this inverse head and shoulders. You can see it yourself, left inverse, right bang, but when you actually look at it, it's just back within this prior range. So on the way up, we spent a lot of time in May and June between 134 and 136. On the inverse, we're basically doing the same again, right? So this is an inverse of what happened, right? We range, we break out, we come back down. We range, we break down, we come back in. So this is really going to be very, very interesting now. Rather than looking at the technical patterns, the head and shoulders, the inverses, ignore all that as my best guess, and really looking at seeing if this DXY, as I said, does break up or volatility does pick up on the inverse to that, then you're obviously looking to probably fade this cable print. Now, the other thing I would also say is when you actually pair this back for a second, let me just remove all these lines and just kind of create a little bit more of a simple structure. When you actually look at how aggressive the cable has been, right, it's had short-term high, correctional movement, new high, correctional movement, new high again, up into that 138 print, smack bang, kind of what we talked about. And from there, we've actually seen the markets dip. So when you look at the higher time frame on the weekly, you've had a bullish break in cable, taking out that 136.50, which was basically the short-term high. So when you go back to that 136, 136.50, that was the emergence of this sell-off. This sell-off that occurred between 2022 into the autumn of 2022, where we had that massive down and back up. This was really where it started from. Now, yes, we were pivoting lower, but this was the emergence of that move. We obviously got back up, honing in on the last few weeks, closing above, getting back down, but symbolically, as I said, even taking out that low. And that for me is really pivotal when you look at the weekly time frame. So we've inside out, broken up, breaking down, new structural low, back up into the value area. So even when you look at it on the weekly perspective, I actually still think this has strong probability that we probably start to fade pound, with the likelihood of, well, if you're getting that type of move, you're breaking down, you're creating a new low, you're coming back up, you're reacting and testing that value area around the 135s, you're creating emphasis on wick but closing up, wick closing back up. So if you're getting a down week this week, I think that's going to be the narrative to potentially try and push this down, really try and have a run at those low 130s for the probability of starting to create a correctional movement against this impulsive move that we saw through January, February, March. Now that doesn't mean we go the whole way back down, but it certainly wouldn't be surprising that if we were to revisit the 130s. Now, what does that mean on the DXY? Well, we've talked about the DXY in quite a length, that every time the Fed cuts interest rates, the dollar actually rallies. So everyone who's expecting that dollar to give way in September and autumn when the Fed cut, it can or could be very easily fooled, because of course when you go back to 2024, the same thing happened. The Fed cut rates, the dollar rallied. Same thing in 2017, 2018, when the Fed actually started to cut rates, it actually rallied. And that really creates that kind of buy the rumor, sell the fact scenario where everyone's pricing all of this in, but it's the retail traders who are going to be caught offside because they're expecting that to continue, when a lot of the move has actually been done 6 months ago. And that is exactly what we've seen in the DXY, which of course fell from 110, 112. Sorry guys, let me just tidy this up a little bit. If I go back up to weekly for a second, get my little crosshair, and that's exactly what we mean. So this is exactly the sell-off, because of course the Fed were expecting rates to cut. So it wouldn't really be surprising to me if we actually saw a break above 99 this month. And then it's really a case of, does that narrative here that we're seeing in cable actually elongate, where we see euro dollar potentially breaking down sub 116s down into maybe the 112s, 113s. Cable again breaking down from 133s into those maybe low 130s, even as a short-term correctional play. So it's just something to be mindful of. If you go back to, as I said, the 24, this was when the Fed cut last year. As you can see here, the dollar actually went from 101, 102 up into kind of 107, 108 before it created a top at 110, right? 110. If you go back to 2017, 2018, around the same time as the Fed was cutting, dollar rallied, right? So this was the inflection point in 2017, 2018. So this is what I'm trying to say is, under the Trump environment, under the Fed current policy, when the Fed cut rates, don't be surprised to see the dollar actually get strength rather than continue being weak, right? I thought about the DXY going to 92, 94. Ideally, I kind of said 94 as a fairly strong probable case, but over the last 3 months or so, or last 2 months in particular, we didn't really see that continue, because of course from about the middle of July into the early part of September, the DXYs remained fairly flat and consolidated, rather than basically invalidating here and incrementally moving lower, rejecting this and continuing the trend lower. As that didn't happen, and we've broken the short-term high, we've come back down, we're formulating consolidation. It certainly looks like at this moment in time the dollar is leveling out a little bit. Now again, the invalidation for me is if we were to break through 97.5, different story, different argument, different discussion altogether. But there's certainly the idea that maybe there's starting to be an inflection point in the dollar, and I would just say be careful of that, because of course if you're still one directional in your viewpoint, you could very much be caught offside, and then you're reacting. Where do I get out of a position? How do I hedge the risk? And these become all too real conversational points. All right, so please keep an eye on that one. Okay, now to round out the indices, as I said, fairly strong correctional movement. As I said, I would still like for this to move a little bit short-term higher on the session, but incrementally watching the S&Ps around that kind of 64.50 handle. I'm watching that VIX. VIX is still pulling back into close, so it's doing exactly kind of what I'm expecting. If we see a gap close tomorrow, keep an eye on that. We'll be on board to watch that in tomorrow's US Open. And of course, seeing how extreme this recovery is off the low. Now, for all intents and purposes, we could go all the way back up, which is back to today's value area, which is around, or back to yesterday's value area, which is around about 64.70. So it's still about 50, 60 points higher. So let's keep an eye on that over the next day or two. Again, NASDAQ, it's doing a similar type of scenario. The only thing is, if you look at the 4-hour closures on the CFD side, and the futures will be slightly different. It's actually got a closure underneath. But when you look at it on the daily with the wicks, of course, it's creating, again, a wick bottom. So let's see what happens there. That 23 handle is holding as short-term bottoms. We can see it very, very visibly on futures, on CFDs, within these markets. That's obviously quite interesting. Again, if it continues to move short-term up with the volatility curve coming back down to 16.5, 17, look for this NASDAQ play to potentially move back into that retest area, which of course is springboarding this, as I said, dead cat bounce, short-term recovery, and then looking to see, does the VIX incrementally try and pick up? If it does, narratives and news go with it. Well, then of course those would be potential selling points. Okay, so let's see what happens there. Oh, it's a little bit messy. Let's see what happens. Let's see what happens in here. Okay, so that would be an interesting area on the NASDAQ. It will also be an interesting area on the S&Ps as well. So keep an eye on both of these levels to see how extreme the correction is tonight into tomorrow's trading session. The other side of things is, as we look at the Dow, Dow has incrementally broken. So this was the Dow, basically top, retest of tops, aggressive V-shaped bottom, all the way back down, mitigating all of this aggressive movement. So basically all of the 2024, or most of the 2024 moves was undone, and the 2025 move initially was undone by this corrective move that we saw in March. Since then, obviously, Dow has been very good in its progressive movements. It's got to new all-time highs. It's broken new all-time highs, as you've seen over the last week or so. It broke up last Tuesday. Its formulated highs just shy of 46,000, around about 45.7, 45.8. And as you can see today, it has come back down to retest. So That is also going to be quite interesting over the next few days, because of course when you look at it, you will see this aggressive breakout on the 4-hour perspective into this kind of period of cool off, mitigating factor, basically price action pulling back down to basically take out the initial volume or liquidity on the breakout. But when you look at it, as I said, on the daily or weekly, you've got this massive break and retest. So it's going to be a big week for Wall Street. It's really going to be an important week, because as I said, if we get a closure underneath, then you're really looking at this not just pulling back into this short-term area where we bounced last week, 44.8s. You're really looking at this being like with the other two, short-term dead cat bounce recovery. But if the sell-off becomes more entrenched, you're looking at price action closing really back down here, moving back into 44.8s. But don't be surprised if we have a dip back into those low 44s. So let's just be careful of that. If, of course, the selling doesn't come, right? So what's the inverse of all of this, right? If there's no selling coming and the VIX actually breaks back underneath this yellow area and incrementally just pushes lower, well, then what's going to actually happen is, on the inverse, you'd actually expect the NASDAQ to break out through yesterday's value area, push beyond Monday's value highs, and really try and have a retest of those all-time highs, which is 23.9. But that's contingent on volatility actually rolling over. So if that rollover goes all the way back down to the 14 prints, well, then we know this impulsive move was more a false break, which is again short-term correctional play. And then we look to see if there's any sort of subsequent bounce later in the coming days off of this 14-15 print. NFP on Friday could be a catalyst. Just be conscious of that as well. So there's two scenarios we're looking for. We're kind of taking it session by session. We're evenly poised regardless of which way the volatility curve implies, and regardless of which way the sentiment goes. We have a plan in place to react to the movement, okay? And I think fundamentally that is important. And then, as I said, last but not least is Europe. Before we round out with a quick look at crypto, this was the DAX over the last probably 8 weeks or so, very consolidated between 24 and 24.5. We obviously had that V-shaped bottom. And of course, on Friday, we talked about last week how that European equity markets was becoming very fragile. And we talked about the idea that don't be surprised to actually see a little bit of a move out of European equities, a little bit more of a drift back into the US. And we saw that very, very clearly this week with that very, very strong correction move. And we've gone from 24.5 last week down to 24 over the course of the week. And from today and yesterday alone, European markets is again sold off from that 24s down into those 23.5s, which is August month end lows. So that is really going to be the inflection point. If we see more selling in global equities as a whole through September, you'd absolutely expect this to give way. And you'd really expect the DAX, which was very, very, very aggressive in Q1, to actually start moderating, with the strong likelihood that H2, second half of the year, finishes either flat at best or more likely being a down half yearly cycle, of course, which would really mean the DAX potentially flowing underneath 23.5s, with the possibility of maybe moving back into those low 20s, 21s, 22s, and basically correcting against this impulsive move that we saw from April. So let's see what happens there in Europe. As I said, Europe's quite fragile at the minute. There's definitely more of an emphasis again moving back into the US as this whole kind of tariff narrative seems to evaporate from the media prints. So just keep an eye on that one as we move into, as I said, September and over the next few weeks. In terms of the FTSE got that breakout. We talked about this type of movement. We got the reaction from 93s last week. We talked about in the US Open. From there, it's been a steady staircase decline. One lower, one lower, one lower. Each day's value area moving lower successfully back into this 91, 91.50 area. And we kind of talked about that on Wednesday. We're really looking for this to pummel lower back into that 91.50 handle. We actually went lower, and at one point today, we were just trading at just above 91s on the FTSE. So that's going to be an interesting one as well, because of course this FTSE play very, very aggressive since that April bottom, and it too hasn't had much of a correction. So naturally this 91 is going to be very interesting over the next week or so to see whether that breakout and pullback is merely just a correctional play in this aggressive trend, of which the FTSE has really been a benefactor of, or actually whether it's inflection point and we actually see a moderate H2, of which case then you're really looking at 87s, 88s, retest the prior all-time highs from March, really coming into focus with the potential of it actually breaking down further. So 91s is going to be interesting. I do think that over the next couple of weeks, if the DAX breaks 23.5 and the FTSE breaks 91s or marginally under 91s, I think you could see a little bit more risk aversion into Q4 on the FTSE and on the DAX. Okay, so let's just keep an eye on that one. And then, of course, on the Bitcoin story, we've been following this quite closely. This breakout retest off the yellow area. So we were looking at this last Tuesday. Initially on our Zoom, that was the bounce back. Then, of course, we had a little bit of a dead cat bounce into last Wednesday. Again, rolled over into month end. We were quite flat on Friday into the weekend. And we've actually seen a little bit more positivity out of Bitcoin and Ethereum today. But again, quite interesting that bounced and has shown significant consolidation at that retest level on the higher time frame. So for me, retest level was this structured move, shorter term wedge or kind of triangular pattern, massive breakout, triggering of liquidity and longs, unwind all that, trap all of these people who are long on leverage, and then ultimately retest the breakout. And as I said, from there, it's going to be very, very, very interesting. Now, the other thing is I'd say today is that Michael Saylor has bought another 4,605, I think, BTC. Don't quote me on the exact number, but it's around 4,500, 444 million USD, and he brings his total BTC holdings to 636,000. So he is still very much levered heavily long. Now his average buy on BTC has now gone to 73,000, which is basically those April lows. So interesting narrative there. We're getting that breakout, we're getting that pullback. Interesting week. Now we know September traditionally isn't a great month for crypto in the crypto space, and of course considering that August has turned a little bit sour as well, it'll be really interesting over the next few weeks whether this Bitcoin actual play holds this yellow area around that 107, 108 handle, or actually drifts lower back into those low 100,000s, maybe high 90s. So you're talking 99, 100, and creating a correctional play, which basically unwinds the whole move that we saw in June. So this end of June move into July, into the middle of July, basically becomes completely wiped out and undone. Same principle with Ethereum. Last but not least, this breakout for me is very, very interesting. So of course we nabbed all them highs, we got there, we took out the highs, we're now in retest mode. I've been a big advocate of that 39,54,000 retest zone. We're slowly but surely working ourselves back down, and when we actually look at it, the Ethereum breakout and pullback is almost identical to the VIX breakout, and it too is pulling back. So keep an eye on that one. I do think that the Ethereum play probably is a little bit more downside to go, of course, given of course that we're back into that 42, 43 short-term area. But as I said, if 42 gives way, you'd be really looking for that move lower back into that 4,000 print, which of course we talked about last week in the futures chart as well. All right, so keep an eye on that one. Of course, the Ethereum is still creating lower low, lower high, lower low, lower high, lower low within this structural piece of price structure or price action. So that of course garners interest as you move, as I said, into September and into Q4. Now again, the ideal scenario would be for September to be bearish, get back down, retest, maybe dive off another 5, 6, 7% through the course of the month, whole volume around that 3,800 to 4,000 handle, start to see buying coming in at the end of September, and incrementally start pushing up into Q4. That would be the ideal scenario. That would be the crystal ball scenario. But whether that happens or not, let's obviously wait and see. All right, so guys, I'm going to leave it there. And ladies, quite a lot gone through tonight in terms of the calendar. Prints, of course, for the rest of the week. And of course, the price action seasonality factors coming through for September. So I'll be back tomorrow for 220 for the US Open. But until then, have a lovely evening and trade safe for those of you who have active positions. All right, thank you, everyone. Have a good night. Thank you.